All right, now the property market is in full swing, in case you hadn't noticed, depending on where you are in the country, I guess, but it's pretty much seeing that everywhere. But even in this low credit rate environment, one of the major issues facing consumers is access to credit. The government is attempting to make this easier. To tell us more, Anthony Landahl from Equilibria Finance joins us. Anthony, good to see you.
G'day Andrew, nice to be here, mate.
Yeah, so look, obviously the Reserve Bank, no issues with where we are as far as the loan structures at the moment are concerned. We're seeing that growth there. The property market is roaring. So why not make it more easier to gain access to credit? How are they doing that?
Yeah, as you said, the RBA has intimated that rates are going to remain low. Monetary policy is pretty well set for the next 2 or 3 years. There's two bits of regulation, I guess, that are relevant to consumers at the moment, because access to credit is difficult. Funnily enough, you see some of the data out there and how much credit is out there in the environment, but actually accessing it is quite difficult at the moment.
Are you talking about owner-occupier, investors, is it across the board?
I'm talking about owner-occupier, I'm talking about investors, I'm talking about small business owners.
Right.
And the two bits of legislation, one which passed Senate, is around the comprehensive credit regime now becoming mandatory. There were some amendments that came in that are going to that should assist those with good credit scores access credit. Should make it easier through across the board reporting. All providers need to be involved. The information getting provided by the credit providers is now mandatory, and it's a lot deeper with more context. The second bit of legislation down the track that's in front of Parliament at the moment is around the responsible lending laws and changes around that from laws that came in 2009 that have now evolved, and they're quite draconian now in terms of basic applications for consumers with good credit history, just getting bogged down in debates about living expenses, reams and reams of paperwork that just don't make sense and don't reflect the history of some of the consumers.
But is this change now, the onus will be more on the borrower than the lender?
That's spot on. Historically, the laws were around the lender having to verify information. The proposal is to flip that on its head and say, okay, the borrower has some responsibility here to be able to demonstrate they can make the repayment. So instead of the providers having to verify every line item in 6 months of bank statements, there's a borrower obligation around the responsibility of this is our situation, this is our credit history. Particularly for straightforward refinances or someone in a strong position, it should make access to credit a lot easier. Going from box ticking, box ticking from the providers to actually a more common sense approach, particularly with those with good credit history, strong serviceability, and demonstrated history of making repayments on facilities.
So what sort of timeline are we looking for the changes in this type of legislation?
Yeah, so the comprehensive credit reporting becoming mandatory and also giving deeper context, that's coming in as of 1 July. The responsible lending changes are currently in front of Parliament. They're looking at them again in March. One thing I should say is that consumer protection laws are also being strengthened. So responsible lending is not going to become irresponsible lending. In fact, it's more just around the language they're using, but consumer protection, those that are vulnerable, those in financial hardship, a lot has changed in the credit environment from when those laws have come in. What we're really just talking about is a more common sense approach to those with a good credit history, those that have a demonstrated history of repayments, and those that clearly can show that they are able to make the repayment. A great example is the Westpac versus ASIC case, where the judge essentially said, if you get a mortgage, you're going to stop, eating Wagyu and drinking Shiraz every night. It's just common sense. So that should ease access to credit, bring lead times down. There's some banks at the moment with 30, 40 day timeframes before they pick up a file. That is just unacceptable for someone trying to access credit.
Anthony, we've seen the heat in the New Zealand property market, particularly in Auckland, and therefore the RBNZ has stepped in just as far as macroprudential regulation is concerned.
Yep.
Are they the canary in the coal mine, do you think, as far as Australia is concerned? I mean, did you see a tightening here at all?
A couple of years ago we had that macroprudential regulation step in around interest-only loans, particularly to owner-occupiers. And we've seen a shift in behaviours due to some of that regulation already. It doesn't feel like there's a lot on the horizon. APRA's pretty well across what's happening and supportive of the monetary policy. I think if they do anything, it's going to be mainly around some of those caps in terms of loan-to-value ratios when they get up high, in terms of maybe limitations around what some of the providers can do in some of those riskier areas, interest-only loan-to-value ratios. But again, for those with good credit history, loan-to-value ratios under 80%, they should be getting rewarded for what they're doing. So I think the regulator has set some guidelines a couple of years ago. It's actually seen a shift in behaviour from providers, and we're still seeing that. We see banks shift their ground around access to interest-only loans or certain loan-to-value ratios. We see that happening now. So that still gets filtered through and is still playing out in the market.
So do you think those banks are very flexible in terms of how they can change their structures to address these issues?
There's a level of flexibility because the regulator essentially says that they put a cap on it. They give parameters around and guidelines around some of the loan-to-value ratios interest only. So the lenders will shift ground through either increasing interest rates, through changing a policy, and then that'll filter through to us. So we might be looking at a provider 3 months ago and a policy may have shifted within that time frame based on that sort of regulation.
The running theme we've been touching on this hour has been JobKeeper, obviously coming off at the end of March.
Sure.
We've recently gathered, those loan deferrals have come down, and we obviously the CBA yesterday giving us those figures, I think we're 25,000 down to a significant drop. Do you have any concerns once JobKeeper comes off that it is going to hit some of those borrowers?
Yeah, look, the good news is exactly what you said. Loan deferrals have come down. I think the other thing we have seen that those people that are still in some sort of hardship, I even know from some of the people we deal with, there still have been opportunities to address that with your provider. Now, the providers are now cutting that off through January, February and March, but if someone has needed an extension of interest only or an extra couple of months, they've still been able to discuss that with the provider, albeit the parameters have changed around how they're assessing that, but there still have been opportunities for those people who might feel that they're going to have some issues beyond JobKeeper to address that with their provider. So hopefully people have been doing that. So that should assist with suddenly a drop-off and someone unexpectedly saying, I can't pay my mortgage, because the providers have still been open to those conversations, albeit the assessments change. Some of the provisions they're giving are a little bit more stringent and may not have the same time frame, but there's certainly still some flexibility around what can be done. But that's going to end as well in the next month.
Well, I'm thinking in particular, I guess, of small business owners who may be in extreme stress at that point. Yeah,
small business owners, it very much depends what lens and what industry you're looking at. Obviously, there's a lot of talk around hospitality, and the risk with the hospitality is mainly around their cash flow and getting back up and running to be able to sustain the drop-off. But again, there's a lot of talk of a cliff, there's a lot of talk of those things happening. I take a slightly different view that small business is very adaptable. Businesses have seen this coming. They've had a fairly long runway. The government is talking about some other provisions and has already put some stuff in around encouraging people into new industries and support like that. So I don't see a cliff coming so much as there will be some fallout. There may be some businesses that don't fully adapt, but I think we're pretty resilient as small businesses. A lot of them still have access to those small business loans and may not have used all those funds, the short-term funding that was there. So I think there'll be a fairly cordial transition given everything that's going on.
Anthony, given all that, how much hotter can the property market come over the next few months?
Yeah, it's warming up. There's no doubt about that. Yeah, the phone has been melting, but look, there are some regions that are really strong. Northern Beaches, Central Coast, some of those regional areas, and what we're seeing in some of those areas is as well investors coming back in. So I even know from the demand side, there are a lot of buyers out there, and what we're seeing prices going 10, 15, 20% above what the real estate agents are talking at the moment. $100,000, $200,000 higher than what they might be talking about. So yeah, I think we're going to see continued growth. We're already back above pre-COVID levels in most areas. I think Victoria's still catching up, but I think across Australia, we're going to see a pretty strong year in the housing market, and that's going to be mainly Australians. The foreign investment's still quite slow, but we are seeing some investors come back in, but there's a lot of owner-occupiers out there, and demand's outstripping supply, so we're going to see those prices keep rising.
Yeah, a lot of tree changing and sea changing at the moment too, isn't there?
There is, yeah, there sure is.
Anthony, thanks so much for joining us from Equilibria Finance.
No problems at all.